Directed IRA Saturday webinar here with Quest Trust Company. I am super excited to have Chris Miles here joining us today to talk a little bit about how you should be planning for any potential inflation, which is a huge topic of discussion right now. So thanks to everyone for joining us today. Kind of as we let people get signed on here, I do just have a couple of quick announcements for you guys. If y'all watch our webinars, you know that you've seen my face a lot up here. But for those of you guys who may not know me, my name is Haley Gant. I am one of our IRA specialists here at Quest, and I work very closely with the rest of our marketing team to help to put on all of these events and education for you guys, bringing in different guest speakers, as well as all of the external presentations that we do with Quest as well. You know, obviously, right, we do travel around a lot and do presentations pretty much all across the US. And we are really excited to hopefully be getting back into that here in the next few months. But we do offer a lot of great educational content online. And even when our events do get back in person, we will have that dual stream capability as well. So, just a couple of quick announcements about us here at Quest. If it's your first time joining us, first of all, welcome. As I was kind of mentioning, this is just one of many educational classes that we host. But Quest Trust Company at our core, we are a self-directed IRA custodian. So basically what that means is that we teach investors how to utilize those old 401ks or IRAs to invest into assets outside of the stock market and outside of the typical publicly traded securities. So at Quest, we teach our clients how to use their IRAs to invest into real estate, notes, other types of privately held assets, private placements, apartment complexes. You can name it. You can probably take title to it in a self-directed IRA. And that's exactly what we specialize in. So physically, we are based in Texas, but we do have clients all across the US. You guys have probably already heard me say y'all once or twice. We are homegrown right here from the state of Texas. We do have offices in all three major cities in the state, but we have about 20,000 clients all across the US. We do operate in all 50 states, and we hold about $2 billion in assets under management. Now, the reason why we like to touch on that, why that is important, is because all of that $2 billion in assets under our management is all privately held assets that our clients self-direct and actually choose which types of assets that they want to hold in their IRA. So to a lot of people, self-directed IRAs can kind of be a new concept. There's not just a whole lot of people out there doing this type of education that we do. But it's one of the reasons why we are so passionate about putting on these events, bringing in different guest speakers, and educating not only about self-directed IRAs, but the types of deals that can be done and the due diligence that comes along with these investments as well. And again, we're a pretty good sized company. A lot of our staff does actually hold the designation of a CISP, which is a Certified IRA Services Professional. And I think that's kind of cool because in order to obtain the CISP, you actually have to have worked at an IRA company for at least 2 years. So a lot of our staff has been with Quest for a long time. We've kind of grown with the company over the years. Me, myself, I've been with the company for almost 5 years. So we really enjoy teaching people about this, and we really enjoy not only educating about IRAs, but providing a high level of customer service as you are self-directing your accounts and kind of figuring out how this whole process works as well. Now, that being said, it is very important that I do cover our disclaimer here. Please be aware that at Quest, we do not give tax, legal, or investment advice. We provide a lot of education about IRAs, different investment types. We bring in a lot of different guest speakers, but it is so important to make sure that you always do your own due diligence before you enter into investments, and make sure that you're taking the time to really structure your deals properly, whether it's with your IRA funds or whether maybe it's with non-IRA funds. It is so important to make sure that you're working with professionals, you're taking your time to vet and research the people that you're working with, and make sure that you're not rushing into investments. It's really important. We really cannot emphasize that enough. You know, at Quest, we're always here to educate and kind of help to point you in the right direction. But just make sure that you are doing that extra level of due diligence, no matter what types of investments you might be investing in. Now, if you've seen these intro slides before, you know that sometimes I go into the types of accounts, the various benefits of a self directed IRA, but I'm going to go ahead and skip over that today so I can focus a little bit more on our upcoming events and our new promotion that we have going for this month because it is actually May 1st, very first of a new month. But be sure to get in your IRA contributions. If you have not already, the tax filing deadline has been moved back to May 17th for most of the country. This year is just a weird year. If you are in Texas or a few other states that have been affected by the recent winter storms back in February, you actually have until June 15th to submit your taxes for 2020. So make sure that you're meeting with an IRA specialist. Make sure that you're making your annual contributions before the tax filing deadline because you still have until May 17th, but that is quickly coming up. It is just 2 weeks away. And I know that overall, from year to year, the contribution limits are not that large for each year. Depending on what types of accounts you're contributing to, but it's not about what you can put in every year. It's about how can I start with something now, start investing it, start growing it by at least some sort of marginal interest rate. And 5, 10, 20 years from now, if you keep doing this, you're going to have a lot more saved up than you might really imagine that you could. So be sure to do that. Make sure to meet with our IRA specialist. I'll have our contact information here at the end of these slides. And we're definitely happy to help you get started, especially with our new promotion that we have going on for this month. But before I get to that, I do just want to let you guys know about our upcoming events that we have. Be sure to check out our other educational resources. We live stream all of these classes live on YouTube and Facebook. And our YouTube is a really great resource to rewatch not only today's class, but any of the other classes that we have hosted recently at Quest. They are all available on our YouTube channel. We also host weekly webinars, self-directed IRA Saturdays, and my personal favorite is our virtual networking happy hour that I actually personally host myself twice a month. It's a lot of fun. It's actually set up as a Zoom meeting. So everyone at the event gets a chance to share their cameras. I kind of go down the list and everyone gets a chance to introduce themselves to the group. And then we open it up for conversations at the end. And at every happy hour, we have roughly 50 to 70 investors from across the US that join us. So it's a great place to meet other investors. It's really created a nice little ecosystem of, Quest people, IRA investors, people that are looking to learn. So be sure to check those out. And I do believe I have Nicole, today's moderator, here online in the chat. She should be sending those links for you guys. So be sure to check those out. Also, this July, this is our next big event that we are hosting. It's a brand new event that we've never hosted before, and it is our Quest Summer Intensive. This will actually be a 3-day event. It'll be 3 Fridays in a row, 3 half days, where we are bringing out speakers to give high-level presentations that will really pack a punch. This is not the basics event. This is the event where you're going to get the nitty-gritty technical information. And each day we're going to focus on different investment types. So you can come one day, you can come all 3 days, you can watch the recordings later. And tickets are cheap. They're $25. But since it is one of our larger productions that we are putting on, this one does have a ticket price. But most of our other education is almost always free. But these larger events, be sure to check them out because there's a lot of great information that's offered at these events that you really have time to dive into a little bit more than you really do in just like 1 hour long class. Now, we have a new promotion going on for this month. I've already hinted at it a few times already. It is May 1st, so it's the first day that we are officially waiving account opening fees from now until May 17th, which is the new tax filing deadline for this year. You can open up your IRA at no cost, as many accounts for you and your immediate family. Now, I would definitely recommend reach out to us to schedule a free consultation first. That way we can really answer all of your questions, walk you through the exact process of how it works, the different types of accounts that might be applicable to you and your family. But we're waiving account opening fees. So great time to save $100 off of that account opening fee. And that goes through now until May 17th. Now, here's our contact information. If you guys have questions, let us know. We are always happy to help. If you scan this QR code, you can actually sign up for a free consultation with an IRA specialist in under 30 seconds. It's very fast. And if you log on to our website during our business hours, you can actually chat live with an IRA specialist there as well, or give us a call or send us an email. And we are always happy to help answer those questions for you. Now, without further ado, I'd like to go ahead and bring back Chris Miles from Money Ripples. Chris, I'm super excited to have you here today joining us, I believe from Utah, if I remember correctly.
That's right.
Awesome. And you are here today to talk about how to prepare for inflation. So I'm really excited to hear about this topic. If you guys have questions, be sure to send them to the Q&A box, and we'll come back out at the end and we'll be answering all the questions. So Chris, go ahead and take it away. Happy to have you here today.
Awesome. Well, thank you so much. Hey, I'm going to see. I don't know if I don't have the ability to do it. So I was going to try to give you a little emoticon reaction, like a little clap or whatever, but can't do it on here. So that's okay. Well, I really appreciate, Haley, you having me on, and the rest of Quest Trust. Say that 10 times fast, right? Definitely excited to be here on this Saturday morning, and really just excited to be here with you. So anyways, I want to kind of go into this topic at hand. I'm if you guys have ever, some of you, I know you guys follow me. If you've ever followed my podcast, I don't like to mince words. I usually just like jump right into it, right? And that's kind of how I am too. But those of you who don't know me, I'm really, I'm kind of the anti-financial advisor, right? And it kind of says that right here too, is that I'm a cash flow expert and anti-financial advisor, where I did start out doing the whole traditional mainstream financial advisor type stuff, but then over time I realized that, it hasn't really worked, like the typical traditional mainstream things. I was securities licensed selling mutual funds. And I realized that the richest people that I ran into would make fun of me, right? They'd make fun of me as a financial advisor. Not to mention, every time you have financial advisors, they tend to make less money than the people that invest with them, so it's always interesting. So, actually 2006 was kind of my turnaround time. Is actually, I went more to the alternative space, right? Because I had a guy I trained to be a financial advisor who quit, and I called him up at the end of 2005. I said, "Hey, how are things going? I know you quit to do real estate," and I'm thinking he's going to say he failed. Boy, was I wrong. And it was the exact opposite. In fact, he said, "Man, in the last 4 months, my dad and I have partnered on some deals, and we've doubled my dad's income as a professor at the local university." And I said, "Come on, that's too good to be true, right?" And he's like, "No, man, like we're doing it. Like it's amazing what's going on." And we went back and forth about what's better, stocks or real estate. Because I told him, like, real estate doesn't go up much. It's only like 3% a year. It's barely inflation, right? And all that kind of stuff. But I'll tell you, the thing is, he just said, "Chris, how many of your clients are actually financially free where they don't worry about money? Not retired, because many people are still worried about running out of money, but how many of them are actually feel free?" I said, "Well, none of them, maybe one, and even then she wasn't either, And then he said, "All right, well, how many of you guys as financial advisors are financially free? Like, were you guys not off the commissions you're earning by selling this stuff, but actually financially free from doing these type of investments, the traditional mainstream stuff?" And I said, "Well, I can't think of any, really. Maybe this one guy might be." And I found out he wasn't either once he got laid off. So he was all, as they say in Texas, he was all hat and no cattle, right? And so anyways, I said, "All right, well, you got me to admit it. Yes, there's a hole here." And I kind of already knew this, right? Because I like numbers, I like proof, I like real results. And he said, "Listen, I don't think you're really serious about learning anything more, because I don't want to waste my breath." I said, "Listen, you got me to admit I'm wrong. So tell me, tell me what you've got." He said, "All right, if you're serious, go get the book, Who Took My Money by Robert Kiyosaki. It's a lesser known rich dad book. Pretty much to sum it up, for that book for you guys, mutual funds stink, the traditional stuff, right? And then it's like, okay, well, great. How about, what else?" He's like, "Well, listen to this radio show." And it was back in the AM radio days. And so, I did that. And once I did, it was history from there. I was actually able to become financially independent in 2006, later that summer, when I was 28 years old. And I was wondering what to do with my life, right? What should I be when I grow up? That kind of thing. And eventually I came out of retirement in 2007 to teach people how to get out of the rat race and that sort of thing, and I went through the ups and downs, the recession, everything, and got all my bumps and bruises. Had to actually retire twice. I actually when I was out of the rat race, I had to go back in the rat race and had to get back out. So 2016, I was back out of the rat race again, but this time much more secure, much wiser than I was in my late 20s, with my real estate and everything else. So anyways, guys, my point is
really quick. Sorry to interrupt. I'm not sure if your PowerPoint is in presentation mode or if we're seeing the wrong display.
What are you seeing?
I see like your PowerPoint, like with your slides down the side and not actual in like presentation mode.
Oh, weird. Yeah, that's weird because on mine it shows the whole thing. So let me stop share and try again.
Yeah.
Yep. Let's do this again here. All right. Share screen.
And I think since we couldn't see it, someone wanted a repeat of that book title. There we go.
Oh,
That's
okay.
perfect.
Got it. How's this?
Perfect.
All right. Yeah, the book title is called Who Took My Money by Robert Kiyosaki is that book. So anyways, long story short, here I am today, right? So yeah, I've been on both sides of the spectrum. I've seen the alternative side. I've seen the traditional side. I've been all over. So today, really, I want to get into the question that is on everybody's mind, at least with a lot of my clients, right? Which is, hey, with the government printing money like they're Willy Wonka chocolate bars right now, right? Like, what's going on here? Like, it's going crazy. Are we going to have hyperinflation or not, right? So I'm actually going to address that today. Just give you a little bit more background on me. Let's see if this actually will move now. There we go. All right. So I kind of gave you a little bit, but I live in Utah. Most of the year I go snowbird in the wintertime, so I'm semi-retired. I'm married with 8 kids. I have a blended family of 8. So I have 6. My wife has 2. We just got married about 4 years ago. So needless to say, she obviously loves me more because it was a bigger transition for her to go to 8 kids than it was for me to just add 2 more. I love passive real estate investing. You guys will definitely hear about that. I also do things with really the only 2 active things I do in a semi-retired mode is I do like infinite banking design and like cash flow consulting, being that anti-financial advisor. And I already mentioned I escaped the rat race twice here. All right. So the real question is this. I want to start here because there's actually 2 arguments. Now, believe it or not, most everybody thinks, we're going to have hyperinflation. The truth is there's even an argument for deflation. So the question is, which is which? So I'm going to give you another book title here that I'm referencing here. It's called, before I do that, no investment advice here, just like Haley said earlier, right? We're not doing that as well. So for deflation, the book I'm going to reference here is The New Great Depression by James Rickards, as it says on the book here. This book just came out in January, right? Now, I'll tell you, so Jim Rickards, to let you know a little bit about him, he's actually predicted a lot of different economic cycles. He's definitely big on gold. He's definitely he's made a lot of different predictions, especially about the currency wars happening between countries that aren't often talked about. So he talks about what happened with COVID. How did that affect things, and what's going to happen now? His argument is actually we're in a depression right now. Despite what all the news is saying, we're already there, right? Based on human behavior, because a depression is more based on human behavior than it is based on actual, GDP and things like that. That's more a recession based, but depression's a much different animal. So his argument is there's actually deflation. Now, here's what his argument's saying. I want to make sure I put this in here. Here's how most people are handling their stimulus money, right? All these stimulus checks we're getting. You would think this would drive up inflation, but that's true only if they buy consumer goods, right? If they're not buying consumer goods, if they're not actually throwing money here, then it doesn't work. So notice that of the people that were surveyed here, right? This is February through March. Most of them have been using it to pay off their debt. Just so you know, paying off your debt does not help the economy. Paying off your personal loans and things like that does not help the economy at all. Now, it helps their personal cash flow situation, but as an economy, that does nothing, right? That just gives the banks more money to play with, right? Which right now, the banks have plenty of money to play with. That's part of the issue. Now, they say some of them mostly spent it. There's about 28%, while 19% mostly saved it. Once again, putting the money in the banks doesn't necessarily do anything for the economy, especially if the banks aren't necessarily lending as much as they could be. That's the one change this time around is that 2006, you remember, they gave money to anybody with a heartbeat, right? If you had a social security number and a name, you pretty much could get a loan. Even if you couldn't prove your income, state income loans were crazy. I know I was a mortgage broker back in 2006. So I remember seeing that. And the thing is that people are usually saving or paying off debt. Now, those that did spend it, to see it more broken down, here's what's happening. Of the stimulus checks, over half of what they spent their checks on was food, right? When they were spending the money, it was on food. Then it was utilities. So notice that over half spent money on food, almost half spent money on just catching up on their utilities, paying those. So not even paying for normal stuff. Because again, when the government gives you money, they're trying to get money circulating through the economy. The faster money circulates, the faster money moves, the more everybody prospers. That also is what typically drives up inflation. But it's not happening because money isn't circulating as easily. Household supplies they're buying, they're paying down debts, like we said. They're paying on their rent payments. That's great for us as those in real estate. We love it, right? Vehicle payments, mortgages. Notice it's all saver mentality stuff. I mean, even household supplies is not really like a spender type habit. Finally, we get the clothing at 11%. Other 6%. Household furniture is at 6%. Some charity even. And then recreational way at the very bottom. So guys, that although hyperinflation is coming, and I think that it will, right? There's a big argument there could be deflation. And if there is, if you're trying to prepare for hyperinflation, that could totally throw off your investment portfolio, right? They could totally throw off everything you're investing in right now. There are things inflating currently, right? But it's interesting to see that normally the government wants you to blow money. They want you to start spending money at local businesses and restaurants and doing all this kind of stuff. Well, if that's not happening, guys, that's where we're having an issue. By the way, I know there's questions coming in. I'll definitely get to them as we get towards the end here, but definitely ask the questions so we can address those as they come. All right. So deflation. Here's what James Rickards says is kind of like the ideal portfolio if there is deflation. Here's the thing. He thinks there will be deflation for a few years and then hyperinflation. The other argument I'm going to talk about here is there hyperinflation first and then possibly deflation on the back end, right? So I'm teaching you both because the truth is, all these people out there predicting, any of us that have been around long enough know that we really can't forecast well beyond a year. I mean, 6 months to a year is even stretching us because how many of us predicted 2020, right? I mean, we predicted some things, but imagine how much it was exacerbated by decisions and government controls and things like that just made things go haywire, right? So the truth is that even people that have been famous for predicting certain things, often they don't predict it very far in advance, right? So he says in deflation, now remember, when there's deflation, this means the value of the dollar goes up, right? Things actually get worth more. So cash, he's saying keep 30% in cash because guess what? If deflation happens, say you lose 2% on the deflation side, well, that means that the dollar gets 2% stronger. That means your cash earns a 2%, even if it was just sitting in cash, right? So in deflationary times, cash is king because when people don't have cash, that's huge. Think of the Great Depression. That was the last time we had a really bad deflation. We did have a little bit in 2008, but it wasn't long term. We saw massive deflation in the Great Depression because we had the roaring 20s. Everything was booming, skyrocketing, massive speculation, massive debt, kind of like today a little bit, right? Things were just booming. And then, of course, when things came crashing down, prices came crashing down, right? Naturally, when people... This is more, remember, it's more of a psychological thing. When people get scared, they start holding on to money, which is what we're seeing a little bit, right? So they start holding on to money. They start putting their iron grip on it, right? Well, when they're not spending money, well, obviously businesses aren't earning money. And when businesses don't earn money, they got to lay off employees. And when employees get laid off, they don't have money to spend. And then it's just this vicious cycle where everybody loses their jobs, right? And okay, during the last depression, just so you know, not everybody lost their job. Really, only about a third of people were in a worse position, while another about third tightened the belt. The other third, though, they actually got more wealthy during the Depression. A good example is John F. Kennedy's dad actually went from $4 million net worth in 1929 to over about 80 to 100 million net worth in 1937, buying mostly commercial real estate because that's what tanked during that period of time. So anyways, he's saying cash is big. Treasuries is another one. Treasury still pays a good, consistent interest rate. It's got some guarantees to some level behind it, depending on what kind of treasury you're buying. But usually it's U.S. treasuries. And again, that's the thing. Residential real estate. He says real estate is great. It's awesome, especially where, even if rents have to come down. The thing is, a lot of times interest rates are just tanking as well. Again, he says you could still have raising interest rates and have deflation too. So you got to be careful. Gold, he talks about keeping gold, but not as much as he would say in deflation or inflation times. Equities, he said that the type of stocks or mutual funds you'd be looking at, he was saying mostly really like natural resources, utilities, agriculture, defense, the things that are more like the core stuff of what people need to live on, right? And then alternatives, he put as another 10%. He even added, he said, that there's a lot of things you could start looking at with deflation that could be good. For me personally, I do keep some cash. I keep some cash, but I usually keep it more like inside life insurance policies. At least I'm getting paid something, so it's not just earning point nothing percent in the bank. But that has some treasury investment too. But again, the question is it going to be deflation? And there's an argument for it, but there may not be. So, oh, by the way, he actually says that banks prosper a lot during deflation. So if you're a lender, you'll love it, because as they're paying you consistent cash flow, just like note investing, right? If they're paying you consistent cash flow, a consistent amount per month, and during deflation, that means you're actually getting a raise, because that amount per month actually becomes worth more. Now, let's talk about inflation, right? I love this meme that I saw recently on social media talking about the price of lumber, which we're now seeing skyrocket over $1,300 for the spot price. Just last year, we saw lumber right around $300 to $400 just 12 months ago. And look at it now. I mean, it's just ridiculous. And so I kind of like what this truck shows, showing $800 worth of lumber in 2021. And that's what we are experiencing this. We are seeing inflation, right? So here's kind of my own 2 cents of how you could do this. This is not from James Rickards. He did not address inflation and how to invest during that period of time. This is kind of my own spin on it. Again, take it for what it's worth. This is not a recommendation or anything, right? But cash is essential. You want to be liquid, especially when there's opportunities that come up, right? So, keeping a good 5 to 10% there, still having something with treasuries, or something that's more stable, that you can have. So having about 15 to 20% in stable money. Residential real estate, I think during inflation, the great thing is that rent prices also increase. So just like the opposite with deflation, when you're a lender, right, and you're a lender and it becomes more valuable as they keep paying the same payments, residential real estate tends to have an inflation hedge with it. So I personally love turnkey real estate investing. I don't like managing my own properties. You might, and that's great. But I'm one of those people, I love to be a passive investor. That's how I primarily do it for myself. So 50% I have there for residential, metals, oil, and those kind of things, those kind of commodities. I put it 20%. You might decide to go higher. The main thing is it just depends on if you're looking for a lot of growth. So again, you might blend this depending on what you want to do. I still kept equities there. It is possible that the stock market could keep going up, even though we have not had a period where 12 years increase has happened in the market, where it's been going up 12 years in a row, right? Early 2016 was kind of a weird blip. It was like negative 0.1%, but it was really just flat. It came right back up the next day, so it was positive again. So equities can be good. I'm not a huge fan of equities, but you might be. So, there's something to be said, I especially think this, if equities do start to tank and get more back into that regular valuation, there's another guy that I follow. His name is, I just blanked out. He has the Wellington letter. So if you look up the Wellington letter, if you Google that, I just blanked out on his name for some reason because I've got James Rickards on my brain. But anyways, if you look him up, he actually talks a lot about these different things. He's actually saying that based on the valuations right now, stock market is 249% overvalued, right? So obviously that's where some of the money is going to. I think that people, as they're getting these checks, or just people having more money available, they don't know what to do with it. So this is where dumb money comes in, as you hear people talk about, right? Where dumb money is being thrown in the stock market. It's like, hey, I should buy stocks. It only goes up, right? Hey, I should buy into crypto because that only goes up too, right? And that's what alternatives is too, the 5%. If you're going to do things that are more speculative, great. Feel free to do that. I bought a little crypto back when it was like, Bitcoin was like $5,000 or whatever. But again, like that's totally up to you. If you're going to do something like that, though, if you're going to do something very speculative, I just suggest that, you really just are careful. Don't put money into any of those kind of things unless you think you can afford to lose it. That's my thing, because there's definitely a lot of different bubbles being created by people just having money thrown at them. So this would be more of a growth type of allocation. Again, you can make it however you want if you see inflation. The key is, of course, that cash will not be king during inflation unless you're looking for opportunities. So you do want to have some liquidity, but necessarily keeping it in cash may not be the biggest thing. You might want to keep it in higher paying type of savings, But again, I love real estate and I love metals, and I think that's going to be the place where you want to look for inflation. Now, I mentioned this: is real estate in a bubble? Is there inflation happening right now in real estate? I'm laughing because you probably are too. If I could hear you right now, the truth is that real estate is not really in much of a bubble, right? Definitely lumber prices has been going up a lot, and that could affect things if lumber prices came back into the normal, right? Especially with production. But here's the thing: there's such a massive shortage of real estate in the market. It's not a bubble. See, we created a bubble last time because we were overbuilding. We were doing lots of crazy stuff, right? And there was not to mention appraisal fraud and everything else going on too. Tons of speculation. Lots of people trying to drive up the appraisals and everything else to get more money. You're not seeing that happen today. If anything, we're begging to find real estate properties. So in my opinion, is real estate in a bubble? No. I think whether we go into deflation or inflation, I think that's the one place that could be safe. Again, depends on the kind of real estate you're doing, or where you're doing real estate. There could be some bad spots of the country. I know this for a fact is that, even at the end of 2019, before COVID, we were talking to some of the biggest minds in the real estate world, and they just said, hey, once California sees about 5% mortgage rates, watch it come down at least 10%. You'll see it happen there more on the West Coast, right? That didn't happen. We saw the exact opposite. The rates dropped, and also we saw appreciation in California that really was a shocker. It shouldn't even been happening, but it did, between prices, between interest rates and everything else. So I don't see real estate being in a huge bubble right now. It always can be, but remember the last 6 recessions we've had, only once did real estate actually drop during that recession. That was the last one we just went through. Now, if you want to have a portfolio that's more income focused, if you're focused more on the cash flow side, right, which is what I try to do for my own portfolio, same thing with a lot of my clients. They're always looking for passive income and basically getting out of the rat race now rather than waiting so many years. Well, again, cash is less. Real estate's still up there. Metals, I don't do as much because metals, you can't really cash flow as easily, right? So I still like it. I still want to have it. And you might do a higher percentage. I do about closer to about 5 to 10% myself on the metal side, and you might do more, and that's fine. Notes can definitely be a great option for you as well. Obviously just getting paid, passive income off that. And another one could be business. Business, depending on the business and the environment you're looking at, that could be a great place to look. Whether it be your own business, whether you're going to a partnership, whether you're buying a franchise. Believe it or not, there's actually franchises, and I looked at this last year during 2020. There's franchises that after the initial startup, maybe the first few months, you might work about 20 hours or so a week, but you can even get some of those franchises running and operating to the point where you might be 5 to 10 hours a week at most and still making 6-figure cash flow or income off of that, net profit. So again, nothing's guaranteed, and it's all personalized to who you are. That's why I hate doing percentages, because the truth is you should be investing in places that you enjoy. You should be investing in places you like, but the principle is the same. Is when there's inflation, we tend to see a lot more happening in the real estate and the metals and commodities prices that go up. And definitely, there's still aspects of business that you also see prices going up there, which could lead to more profitability, again, depending on the business. That's where, I love virtual businesses personally, because, you don't have these hard costs, based on commodity prices, right? You're not trying to buy a lot of supplies. If you're buying a lot of supplies, then that could be driven up with inflation, and that could kill your profits. So that's kind of what I see there. Again, we don't know exactly what's going to happen. I personally, this is just my belief, I think we are leaning more towards hyperinflation, and I'm preparing accordingly. But know this, is that every one of you should be able to turn on a dime. And so if you're trying to lock your money up forever into something and it's locked up, and then you think it might be very influenced by either inflation or deflation, be careful. I know a lot of people are starting to look at like self-storage and assisted living. By the way, assisted living got its butt kicked last year. It was horrible. I had a client who actually owned 3 of her assisted living, and just with all the, fear that was going on, right? So people didn't want to put people in the homes, and all the government type of regulations going on. It was just a disaster. And so those that invested in assisted living last year probably saw the same thing. You probably said, ugh, it was a bad year. But remember, whatever has a bad year might also have a good year in future years. Might, I say, right? Same thing in the stock market, right? When everybody was buying techs like crazy last year, now all of a sudden techs are kind of up, but they're not nearly as big as like what we've seen with utilities, and those kind of places. So just know that whatever is hot typically will not be hot later, in the coming year or whatever it might be. So just watch it, be flexible, and see what you can do there. A lot of passive investments I look for, of course, because I like income. And I know income is the one thing I can control today. I love turnkey rentals. I love to do lending. There's great ways you can lend and do that. There's different funds or notes. We mentioned that they might not have a tax advantage, but they might pay you a good steady return, kind of like lending does. There's syndications. Some of them do have great tax breaks. Again, if you have your money in the IRA, you don't even care. So lending and funds and notes can be great inside your self-directed IRA. Syndications, they could be too, depending if they do pass on tax breaks or not. That's another thing as well to look at. I mentioned franchises. Another one I mentioned too, these last two, it's kind of more on the alternatives, more alternative than the typical alternative space, which is more real estate based, is, can you actually have a business that's more affiliate version? Can you actually do good with referrals? Can you refer to businesses and get paid cash flow from that? I'll tell you, whether it's inflation or deflation, the one thing is that business owners are always looking to grow. And if you find a great business, you say, I like them, I want to support them, I think they have something great that's good value add for people. The great thing is you don't have to be that person to deliver it. You can say, hey, you know what? So-and-so over here, talk to this company. They're great. And you can get, depending on laws, of course, like you can't always do that with an attorney, or accountants or, people like that. But a lot of businesses will say, hey, I'll pay you a referral fee. I'll pay you a percentage of my marketing if you help me with this. It doesn't mean you have to be like a massive marketer. Just so you know, 2006, one of the streams of income I had coming in was actually just organically referring people to different companies. Even a wholesale jeweler I referred to in Salt Lake City, that would pay 5%, because people would say, yeah, I'm looking to buy an engagement ring or a wedding ring. I'd say, hey, don't buy from the mall, go buy over here. There's great stuff over here. And I would get paid 5%, there's lots of different businesses you can do that with. Number 7, leverage each other. Like, this is where partnerships can come in. Maybe you're the active investor, maybe you want to be the passive investor, more like I am. Is there somebody actively investing that you like? I know people out there that are doing like different things with tax liens or whatnot. Maybe, right now I'm actually investing in a partnership right where I'm doing land seller financing and flipping and that kind of thing. And and loving it. It's kind of a cool little strategy that can create great cash flow, great returns. And again, I can be hands off. And so, can you leverage people in their expertise? Say, hey, I've got the funds, whether it be in your IRA or not, but I've got the funds. Let me partner up. Let me support you. Let me finance this. Let's do a deal together. And so that could be a one-on-one thing. That could be something different. But that's the kind of thing that's just amazing, right? There's so many more options. That's the thing that blew my mind in 2006 was when I realized there was a whole other world outside just the typical stocks and mutual funds. Like, that was my little tiny world as a financial advisor. And that's what most financial advisors are. We were really just salesmen in suits, right? Well-intentioned, but we just didn't know what we're doing. We're just selling whatever the financial institutions told us to sell, which is what they offer, right? But now seeing outside of that world, it's seriously like taking the pill from the Matrix, right? It's like, oh my goodness, like there's a whole world we haven't realized. So, and I know the thing I love about, Quest Trust is that, man, like they give so much education on this stuff that I don't see all these other companies doing. And I just love it. So again, shout out to you guys at Quest Trust for, creating this opportunity. So again, I love multiple streams of income. I think that's the key. If you have multiple streams of income, you can create freedom. I love Warren Buffett quote, if you don't find a way to make money while you sleep, you'll work until you die. And I know all of you are here for that very reason. You're here because you want answers. You want to be able to do something different, something that actually works, and I'll tell you, looking at evidence, I know that it hasn't worked from doing the traditional same old stuff. But when you're in the self-directed world, when you're able to do things outside of the norm, I'll tell you that the numbers work in your favor. You cannot retire well on earning maybe 7 or 8% real rate of return in the stock market with inflation, especially if it starts skyrocketing. It won't keep up, right? You just can't succeed. Plus, you got taxes and everything else. There's so much more out there, and you guys are really in the right place right now. So my advice from 2020 is kind of similar to now, is no matter what direction we see, is get lean. Make sure you get your expenses down, to a necessary point. Don't go live in a cardboard box. Don't be living on rice and beans. Don't go that extreme. right? But definitely look for things both in your personal finances. If you really want to get out of that rat race faster, look for ways to do that. Look for ways to, kind of trim the budget, trim the fat, as they say, right? Get that down. If you have a business, look for it there too. The best thing about 2020 that I saw with some business owners is that the ones that did it well and pivoted well said, you know what? We don't need all this stuff. Hey, we don't need all this. We don't need, we're not being productive with our employees. Let's downsize a little bit. Let's streamline this better and make better processes and systems. So same thing with your personal money is, can you get lean? Don't get cheap, but get lean. Still enjoy life because you don't know if you'll be alive tomorrow. But at the same time, don't go crazy. Get liquid. Make sure you have the liquidity so you can use this. If you got money in the self-directed IRA right now, hey, look for, you might keep some in cash, and until you can determine where to put it. And then of course, if you are locked up and you don't like where you're investing, get out. Don't be in any investments that bring scarcity, that bring fear, or even better yet, greed into your life. Because fear and greed, ironically, is what drives the markets, but it's also the very thing that makes people go broke. So you got to be very wary about how it creates with your emotions. If you're seeing things that make you extra greedy and a little bit taking extra risk you shouldn't be, listen to your intuition, listen to your gut, see what's appropriate and what's not for you in your situation. But I've been telling people, get lean, get liquid, and get out, because when you have that money ready, and there are going to be plenty of deals coming up, especially as we start to see what unfolds over the next few years, there's going to be opportunities. There's going to be crashes, and there's going to be opportunities to buy too. And so that's kind of my last advice, is that, guys, cash flow creates freedom, right? It's when you have more cash flow and money coming into your life, especially when you're making better returns than you could normally, that creates options for you. And when you have more options to choose from, that is where you have true freedom. And I'll tell you, I've been there twice now. And the life, it's just a kind of life you can't describe. It really isn't. It's just a life that it takes you to a whole nother level. It takes you out of survival, takes out even if you have great income coming in, it takes out of this place of fear of what if that income stops? Because if you have multiple streams of income, it doesn't matter. Like, you're set. And again, you've got a great support here with Quest Trust here, right? I mean, they've got so many great tools, so much great education for you guys to support you, to ensure that you guys can have some of the best results possible. So again, Haley and the team, thank you so much for having me on today. Really appreciate you having me here. Let's go ahead and open it for questions.
Yeah, definitely. That was a great presentation. I love when you break things down. This is what you should be invested in, the percentages, things like that. So great information there. Let's go ahead and get right into the Q&A. If you guys have questions, be sure to send them to the Q&A box. They tend to get a little buried in the chat, so just kind of helps me out there. But let's see. This is one of our questions from one of our attendees who wants to know, could you explain more about why you think notes will be a good asset during inflation if you are being paid a fixed interest rate and P&I payment versus real estate, which will appreciate in value? What's your opinion there?
I love real estate still, right? I think the biggest thing is, and this might be more short-term notes, not long-term, because, when there is inflation, usually, now this could be totally different because the Feds they're all going crazy, right? But their traditional response is when there's inflation, they raise interest rates, right? And I've noticed over the years that when they've done that, people tend to expect more too. They tend to expect a higher interest rate. So when it comes to lending, lenders know, I mean, they got to be profitable still, but they know that they can't just promise you a 5% return. If all of a sudden you could turn around and go make 5% somewhere else, like even just bonds or something like that, or what rates are going up. So if that's the case, that's why I think notes can still be a good option. But again, that's totally up to you. But again, I'm thinking more short-term notes, not long-term where you're stuck in like 20-year commitment.
Mm-hmm. Nice. And when you say short-term, what type of time frame are we looking at there?
You might be looking for anywhere from 90 days up to a year, something like that, like more short-term lending, or types of notes like that. I know a lot of people are doing things, they're more lending to real estate professionals now that are doing fix and flips because they're taking advantage of the inflation, right? And on the higher prices. So that's kind of what I mean by that.
Nice. Let's see, another question here. Can inflation be predicted by examining futures markets and forward price curves? If so, which one gives the best indicators in your opinion?
I used to think I knew that answer. I'm in this day and age, I'm throwing all out the window. So I really, because even the Feds, the rules they're playing by that did work before aren't working right now, right? Like they've been trying to do all these things with their balance sheet and everything else, and still things are going a little bit different than they expect. And they're trying to calm us down. If you notice, like everything coming out of Jerome Powell's mouth is always like, hey, we're doing great. It's a strong recovery. We're still cautious in the future, but it's strong, right? Well, they got to say that. Biden's got to say that. Congress got to say that, because once consumer confidence drops, when people start getting scared, that's when you see a depression. That's when you can actually see deflation happening. And governments don't want deflation. They want to force inflation, even if it's hyper, because when they're paying interest on their notes, right? That's the truth. Like same thing with debt. When you have debt, inflation's awesome, right? Because your debt gets less and less valuable, right? So it gets cheaper and cheaper to pay off. That's exactly what the government banks on. They don't intend to ever pay off their debt. That's not their strategy in their playbook at all. They're actually planning to run it up more and just keep getting cheap money, because inflation's higher than whatever they pay in interest. They win, right? Same thing when if we leverage doing loans. If we make more in interest than what we pay, we win. We made an infinite rate of return on our money, right? So yeah, predictive indicators, it's tough. It really is, because there's so many moving parts. And so, sorry, I don't have a good answer for you, but I'm just going to say, I don't know, but hopefully in the future we'll have a better idea.
Mm-hmm, definitely. Well, personally, I thought that was a great answer, because some of the Congress, the things like that, starts to get a little over my head a little bit. So it's great to bring people out that are actually educated in all of these different, factors that affect things there.
Yeah.
Let's see.
Well, and this kind of ties in with what Prasad said too. Bert Doman, Kenneth said it right. Bert Doman was the guy that does the Wellington letter. Prasad said it was wrong all last year. That's partly true. He was wrong too. I mean, that's what I'm saying. Like all these guys, even Jim Rickards, like he's predicting deflation, and he's not seeing the same thing from just a couple months ago, his predictions, right? So that's the thing, is like all these guys, they've got good and the bad. I still got a lot from Wellington. I still do today, because again, he's always refining it, right? He's got projections, but he's always refining it to say short term, here's what is coming. And he's been right on the short term stuff. He's like, hey, gold's going to do this, and then a few days later it does, or stock's going to do this, and a few days later it does. So it's, again, take everything you learn with a grain of salt.
Mm-hmm. Definitely, especially in today's crazy world, right?
Especially.
Awesome. So a few more questions here. One of our attendees wants to know, would you advise against commercial real estate during periods of hyperinflation?
It depends. It really depends on the factors of whether hyperinflation is happening, right? Because it could be bad. I mean, there's obviously that could be a horrible, horrible place to be, especially if businesses are going out of business. Now, if it doesn't affect businesses as much, right, then that's fine. Now, right now, I think commercial real estate is pretty tricky. It's definitely not at the low, in my opinion. I think it could still do worse. I think there's a lot of things propping it up. But I think in the future, I think commercial real estate could, especially if it gets hammered, whatever gets hammered the most tends to be the opportunity down the road, right? So if you see it really get hammered more, because I don't think we're seeing the end of unemployment yet. I think there's a lot of things that are coming that I think commercial real estate could be a good bet. I just, right now, unless you're buying it for dirt cheap, you're getting a great value on it, and you can make it work even when it's being stress tested, great. But right, I mean, for me personally, I'm kind of like, I might want to hang back a couple years, just in case, just to see what happens.
Mm-hmm. Definitely. And this is actually kind of one of my own questions that I think fits in nicely right here. So with the craziness of the housing market right now, with hyperinflation and things like that, should I be holding on to my real estate? Should I be selling it? What's your opinion there?
It depends, right? I mean, I guess that's the answer for everything. It always depends. But, like I have real estate and I'm still buying it. I am being pickier, right? Like I'm being really picky. And really the last couple of months, I kind of put the kibosh because they skyrocketed the interest rates on not on your home loans, your typical primary residence, but anything that's a non-owner occupied home, interest rates skyrocketed with mortgage rates. So I'm waiting for that to settle back down. It did the same thing last March through May in 2020. They skyrocketed it way up, and all the mortgage brokers saying, don't buy. By the way, I try to refinance my property. That's another option people could look at right now. I try to refi, and they were I'm not kidding you. The lender was going to charge me 10 points, 10% in origination fees to refinance. The best one I found was 2% origination fees, and it didn't save me that much on my interest rate. So lately, I've been looking more at repositioning. Especially if we've having this inflation going up and they're driving the prices up. Look at your return on equity. Is your return on equity on that property, less than say 6 or 7%? it might be a good time to do a lateral move. Maybe you do a 1031 exchange, move into a new property. By the way, we don't know what Biden's going to do with 1031s. He's talking about trying to, put massive taxes above 500,000 of 1031s. So this might be the year you want to do it anyways, right? So just, be watching for that. But yeah, again, if your return on equity is low, if you're on the West Coast or Western half of the United States, your return on equity probably is low. You probably would want to look out east anyways. You probably will find better, cheaper deals out there than what we have out here,
Definitely. Yeah. Great answer there. This is an interesting question. Can you eliminate the downside of inflation with foreign investment? Where would you invest in real estate if not in the US?
Right now, what I know of, most people that are foreign are looking to buy here. Like, for example, I've got Australian clients that absolutely do not want to do anything in Australia because they're lucky to make 3% a year on the real estate. I mean, that's horrible. I mean, there's way better. So New Zealand, similar pattern, and they've been shut down. So that's even worse. So globally, I think that's another thing you should be doing, just kind of as a side, somewhat tangent, is really do watch what's happening globally, because the U.S., we're not all by ourselves, right? I mean, the global can have an impact on the United States too, especially as we're getting more and more expensive. There's going to be less countries trying to buy from us. There's going to be more of us trying to import things versus export. And if they all of a sudden lose money, they don't have the money, or our prices are just so high they can't afford it, that could actually create deflation here. So, be careful of that. But I mean, with foreign, buying up foreign, I mean, if you know a place, let me know. But right now I'm seeing it's the opposite. Most people are trying to buy here because their real estate, especially with everything being shut down, has not been good lately.
Nice. Very interesting. All right. We'll do one or two more questions here.
Yeah.
They kind of keep coming in pretty regularly. But I do like this one. One of our attendees wants to know, so if you wanted to keep cash waiting in a self-directed IRA, how would you recommend that? My thought when you said that would be good to have that cash sitting in a stock index fund, ready to sell and deploy when that opportunity arrived. Am I thinking correctly?
It's a possibility. I mean, if you're looking at a stock index fund, I mean, go for something very, very conservative. It might be looking more, I hate to say bonds, because I mean, even bonds, I was predicting that those might tank, this even just over a year ago, because there's been a lot of speculation there too. So, I mean, I don't know if I would say look at a stock index. I definitely would not be looking like S&P 500, because that is so volatile and, again, so overvalued. It's really tricky. So if you're going to be looking at something, I would look for something a little bit more conservative, something that's safer. But yeah, you could definitely do an index fund. I mean, that's very liquid. You can move in and out. So it's definitely a possibility.
Yes. And just kind of like from the Quest side of things for that. So at Quest, if you've got cash sitting in your IRA, it's ready to go. It will just be sitting as a cash value. But if you do decide that, hey, maybe you want those funds sitting at Fidelity where they can be earning some sort of nominal interest rate, just be aware of the time frame of once you're ready to sell those off and transfer those funds to your Quest IRA account. Just understand how long that time frame is going to take. Typically, maybe 1 to 3 weeks. But as long as you understand that, we see a lot of people that might move their cash back and forth between their IRAs at any time, just kind of depending on where they're looking to invest it at that time.
Yeah, great point.
Yes. All right. And last question here, at least for now, one of our attendees wants to know, what is the best way to find people to lend money to?
Right now, it's not hard. I mean, I was okay. You could do this. This I take with a big grain of salt, right? I mean, you could always, if you're looking at real estate lending specifically, you could look at RIAs, local RIAs. But just remember, there's a lot of amateurs that attend there, and then there's people that are the pros, right? You definitely want to go there. Right? You definitely want to go that route. So that's what I think. I just say as a big but is just be careful. Don't, when you're doing any kind of analysis on somebody, right? Like you really want to say, okay, how long have you been doing this real estate investing? How have you done? If they've only really been investing for the last couple of years, you don't have to be a rocket scientist to make money in real estate lately, right? It's not hard. So just be careful there. I mean, there's plenty of people willing to take money. There's plenty of people that I know, that both Haley and I know, that have their own funds. They have their own situations going on. But, I would just say, once you find somebody, kick their tires, kick them really well, find out what they're doing, make sure they're putting their own money in their deals, right? Not just taking money from other people. And then really just, yeah, I mean, feel it out. Make sure that you get somebody, and you can create a great relationship. It could be that one or two people that you just have a steady relationship with, and you just keep lending money to, and you can make some great returns doing that stuff.
Definitely. I'm also going to use this to subtly plug the class that we have coming up on Tuesday. I will actually be teaching the webinar on Tuesday, and it's specifically over how to raise private capital from other people's IRAs. And I kind of walk through just some of the things that I've learned in my 5 years at Quest, how to approach the conversation, how to make things go smoothly, and just kind of what you should know as someone who's looking to loan or borrow money, to kind of make these deals go smoothly and then meet the people that you can potentially work with for these as well. So
Yeah.
join us on Tuesday or watch it on YouTube. And last
Great
question
point.
here, Chris, if someone wants to reach out to you, how do we contact you? Do you have any other resources? Walk us through some of that information there.
Yeah, I mean, the first thing I would say is go check out my podcast. Haley, you were just on it about a month or two ago, right? And so
Yes.
check out the podcast, The Chris Miles Money Show. I teach a lot of stuff. I just recorded episode number 500 just yesterday. So big mile marker, I know. So it's been around for a while, but don't go back to number one. It's just too far back. Just stay within more recent ones. There's great content there. And of course, you can always check out moneyripples.com. That's my website, moneyripples.com.
Awesome. Yes. The podcast, be sure to check out the Quest episode, of course. But there's a lot of great episodes there. I've listened to a few myself. Chris, that about wraps it up for today. This has been very educational. Thank you for joining us. But before we sign off for the day, do you have any last kind of closing thoughts or piece of advice that you'd like to leave everyone with here today?
Yeah, you know what? The more time I've been involved in investing, I'll just tell you, you can analyze and try to rationalize everything, but I've learned the best investment decision I've made is going with my gut. If something doesn't feel right, don't do it. If something feels right, even though it may not have all the data to back it up, but it feels right, it might be the right thing for you. And so that's the thing. It's like anything that I say here could be totally wrong next year, and I'm okay with that. The truth is I'm always just investing for income. And so just follow your intuition, follow your gut, do what you feel is best for you.
Awesome, Chris. What a great note to wrap it up on for today. So thank you so much for joining us, everyone. Be sure to check out our other upcoming events and classes, and you can rewatch today's class on YouTube, as well as all of our other recent classes as well. Chris, this has been a great class, probably one of the ones I've learned the most on in the last couple of weeks that we've hosted. So thank you for taking time to join us, and I'm sure we'll see you back at one of our webinars, hopefully sometime soon.
Looking forward to
Have
it.
a great day,
Thanks.
everyone.